Imagine this. You sit down at your kitchen table with your tax forms. You have done this every year for decades. You know the routine. You fill in the numbers. You double-check the math. You hit submit. And then a few weeks later, you find out you just handed the IRS hundreds of dollars, maybe even thousands, that you did not owe them. Not because you did something wrong, but because nobody told you about a brand new deduction that was created specifically for you. Right now, as we speak, millions of Americans over the age of 65 who own a home are filing their 2025 tax returns and leaving money on the table. Money that is legally theirs. And today, I am going to make sure that does not happen to you. I am Jocelyn. I am a senior policy analyst and retirement finance researcher. I spend my days reading the fine print of IRS publications, Social Security rules, and new tax laws so that you do not have to. And I need to be honest with you. When I saw what was happening this filing season, I felt a real urgency to get this video out because the IRS, AARP, and tax professionals across the country have all confirmed the same thing. The number one tax mistake seniors are making right now in 2026 is failing to claim a brand new deduction that could save them hundreds or even thousands of dollars. In this video, I am going to walk you through exactly what this new deduction is. I will explain how it works if you own a home. I will show you the exact IRS form you need. And I will reveal a hidden trap involving your home that could actually wipe out this deduction entirely if you are not careful. Please stay with me until the end, because there is a critical mistake in this video that I need to warn you about, and most people will not hear about it anywhere else. Let me tell you about Robert. Robert is 68 years old. He lives in a 3-bedroom home in Ohio that he bought back in 1994. He is retired. He collects Social Security. He has a small pension. And every year, he sits down with his wife, Linda, who is 66, and they file their taxes together. Robert is careful. He keeps his receipts. He uses the same tax software he has used for years. And in March of this year, he filed his 2025 return. He took the standard deduction, just like he always does. He got a small refund. He thought everything was fine. Then a few weeks later, Robert was having coffee with a friend, and his friend mentioned something Robert had never heard of, a brand new $6,000 deduction for people over 65. Robert did not believe it. He went home and looked it up, and there it was right on the IRS website, a new enhanced deduction for seniors, $6,000 per person, $12,000 for a married couple when both spouses qualify. Robert and Linda were both over 65. Their income was below the limit. They qualified for the full $12,000, but they had already filed. That $12,000 in missed deductions could have saved them over $2,000 in taxes. Money that was legally theirs. Gone. Because nobody told Robert the rules had changed. Now here is the good news. Robert can still fix this. I will explain exactly how later in this video, but Robert's story is not unique. Millions of seniors are making this same mistake right now, and it gets more complicated if you own a home, because there are additional rules about property taxes, home sales, and income limits that can either help you or hurt you, depending on whether you know about them before you file. So let me break all of this down for you, step by step, in plain English. Part 1. The new $6,000 enhanced deduction for seniors. On July 4th, 2025, a new law was signed called the One Big Beautiful Bill Act. Inside that law, there is a provision that gives every American age 65 and older a brand new tax deduction worth up to $6,000. If you are married, filing jointly, and both you and your spouse are 65 or older, that number doubles to $12,000. Now, let me be very clear about something. This is not replacing anything. This is a completely new deduction that is added on top of the standard deduction you already get as a senior. Here is what that looks like in real numbers. If you are a single filer, age 65 or older, your regular standard deduction for 2025 is $15,750. On top of that, you already get an extra $2,000 just for being 65 or older. That brings you to $17,750. Now, with this new enhanced deduction, you can add another $6,000. That brings your total to $23,750 in deductions. For a married couple where both spouses are 65 or older, the total can reach $46,700. That is a significant amount of income that the IRS cannot touch. But there is an income limit. The deduction starts to phase out if your modified adjusted gross income is above $75,000 for single filers or $150,000 for married couples filing jointly. For every dollar you earn above that limit, you lose 6 cents of the deduction. And once your income reaches $175,000 as a single filer or $250,000 for joint filers, the deduction disappears completely. To claim this deduction, you need to fill out Part 5 of a brand new IRS form called Schedule 1A. This form gets attached to your regular return, whether that is Form 1040 or Form 1040 SR, which is the version designed specifically for seniors with larger print and a built-in deduction chart. Part 2. Why this matters. Even more. If you own a home. Now, here is where it gets really important for homeowners. Many of you who own a home have been itemizing your deductions for years to write off mortgage interest and property taxes. And in past years, a lot of seniors stopped itemizing because the old rules capped your state and local tax deduction at just $10,000. That made the standard deduction a better deal for most people. But that has changed. Under the same One Big Beautiful Bill, the SALT cap, that is your state and local tax deduction, has been raised from $10,000 to $40,000 for 2025. If you live in a state with high property taxes, places like New Jersey, New York, Connecticut, California, Illinois, this is enormous. You may now be able to deduct your full property tax bill, plus your state income taxes, plus your mortgage interest, and that total might be higher than the standard deduction. But here is the part almost nobody is talking about. The new $6,000 senior deduction is not an either-or situation. You can claim it whether you take the standard deduction or whether you itemize. The IRS has confirmed this directly. It stacks on top of whichever method you choose. The IRS stated clearly in Tax Tip 2026-12, and I quote, "All new or enhanced deductions are available for both itemizing and non-itemizing taxpayers." So if you are a senior homeowner who itemizes and your itemized deductions come to $40,000, you can add the $6,000 senior deduction right on top of that. Your total deduction becomes $46,000. This means that many of you need to rerun your numbers this year. Do not just assume the standard deduction is better because it was better last year. The rules have changed, and the math may surprise you. Part 3. The home sale trap. Now, I need to talk about something that affects seniors who sold their home in 2025 or who are planning to sell soon. Under IRS Section 121, when you sell your primary home, you can exclude up to $250,000 of profit from your taxes. If you are married and filing jointly, that number goes up to $500,000. That is the law. It has not changed. But here is where many seniors get into trouble. To qualify for that exclusion, you must pass 2 tests. The ownership test, you must have owned the home for at least 2 of the last 5 years. And the use test, you must have lived in it as your primary residence for at least 2 of the last 5 years. This is critical for seniors who moved into assisted living or a nursing facility. If you moved out of your home more than 3 years before selling it, you may no longer pass the use test. And if you fail that test, the entire gain on your home could be taxable. For someone who bought a home decades ago for $100,000 and sells it today for $500,000, that is $400,000 in gain. Without the exclusion, you could owe the IRS $60,000 or more in capital gains taxes. And here is another mistake AARP has flagged. Many seniors forget to include the cost of home improvements when calculating their profit. Every kitchen renovation, every new roof, every bathroom remodel, every HVAC system, those costs get added to your original purchase price, which reduces your taxable gain. Over 30 or 40 years of home ownership, that could be tens of thousands of dollars in savings. Part 4. The Social Security Misconception. I also need to clear up a very dangerous piece of misinformation. Last July, the Social Security Administration sent out an email that suggested the new law eliminates federal taxes on Social Security benefits. That email was wrong. The SSA later issued a correction. The new law does not end taxation on Social Security. Your benefits can still be taxed based on your income level. However, the new $6,000 deduction may lower your overall taxable income enough to reduce or even eliminate the tax on your Social Security benefits indirectly. But that only works if you actually claim the deduction. Part 5. The Roth Conversion Trap. And finally, I want to mention one more hidden trap. If you did a Roth conversion in 2025, meaning you moved money from a traditional IRA into a Roth IRA, that conversion counts as taxable income for the year, and it gets added to your modified adjusted gross income. That means a Roth conversion could push your income above the $75,000 threshold and start phasing out your new senior deduction. Tax professionals are specifically warning about this. One wealth management expert told AARP, and I quote, "If I convert $10,000 of my IRA to a Roth, I also might be phasing out some of my deduction for being a senior." The timing of your financial decisions matters more than ever this year. Please be aware of this before you file. All right, you have heard the rules. You understand the traps. Now let me give you 3 clear steps to protect yourself. Step 1. Check if you qualify for the new $6,000 enhanced senior deduction before you file. Go to irs.gov, search for Enhanced Deduction for Seniors. The IRS has a page that was published on February 27th of this year that explains the eligibility requirements, the income limits, and how the phase-out works. If your modified adjusted gross income is under $75,000 as a single filer, or under $150,000 for joint filers, you likely qualify for the full deduction. Make sure you or your tax preparer completes Schedule 1A, Part 5, and attaches it to your return. That is how you claim this deduction. If you are using tax software, make sure it is updated. Most major software programs now include this form automatically, but double check. Do not assume. Step 2. Reevaluate whether you should itemize or take the standard deduction this year. This is especially important if you own a home and pay significant property taxes. With the SALT cap jumping from $10,000 to $40,000, many of you will now get a larger deduction by itemizing. And remember, even if you itemize, you can still claim the new $6,000 senior deduction on top. Sit down with your property tax bill, your mortgage interest statement, that is Form 1098, and your state income tax records. Add them up. If the total is higher than your standard deduction, consider switching to itemized deductions this year. If you need help, the IRS offers free tax preparation through the VITA and TCE programs for people age 60 and older. AARP Foundation Tax Aid also operates thousands of free sites at libraries and community centers. You can find the nearest one by calling 888-AARP now, that is 888-227-7669, or visit aarp.org tax aid. Step 3. If you already filed without claiming the deduction, file an amended return. This is what Robert from our earlier story needs to do. And it is what you need to do if you already submitted your 2025 return without Schedule 1A. You can file an amended return using Form 1040X. You have 3 years from your original filing date to do this. It is not complicated. You are simply telling the IRS, "I missed a deduction I was entitled to. Here is the corrected return." Do not leave your money with the IRS. If you qualify, that money belongs to you. File the amendment. Get your refund. And one more thing. Remember, this enhanced deduction is temporary. It is only available for tax years 2025 through 2028. That gives you 4 filing seasons to take advantage of it. Do not waste a single one. Before I let you go, I need to say something important. The tax rules that affect seniors are changing faster right now than at any point in recent memory. New deductions, new SALT limits, new forms, new phase-outs, and this is just the beginning. The One Big Beautiful Bill introduced changes that will affect your taxes, your Social Security, your Medicare, and your retirement planning for years to come. And here's the problem. YouTube may not always show you my videos. The algorithm decides what you see. You might miss the next critical update. And when it comes to your money, your benefits, and your home, you cannot afford to miss anything. When you join, you will get real-time alerts whenever there is a new rule change affecting Social Security, pensions, tax deductions, bank regulations, insurance policies, or travel rules for seniors. No spam, no clutter, just the information you need to protect what is yours. And right now, when you join through the link in the description below this video, you can download a free copy of our Senior Benefits Protection Guide. It is a simple, easy-to-read document that walks you through the most important rules and forms you need to know about this year, including Schedule 1A, the Section 121 home sale exclusion, and the new SALT deduction limits. C. If this video helped you today, please hit the like button. It helps other seniors find this information. And share this video with someone you love. A spouse, a sibling, a friend, a neighbor, anyone over 65 who owns a home and has not filed their taxes yet. You could save them thousands of dollars with one simple share. I am Jocelyn. Thank you for watching. I will see you in the next one. Disclaimer: this video is for educational and informational purposes only and does not constitute tax, legal, or financial advice. Individual tax situations vary. Consult a qualified tax professional or use free IRS-sponsored services such as VITA, TCE, or AARP Foundation Tax Aid for personalized guidance. All information is based on published IRS and AARP sources as of April 2026.